Hey, welcome to YSR Shorts. I want to talk today about asset allocation. It's one of those terms that people throw around and, oh, it's asset allocation, and people don't really understand what it is. And people confuse it with diversification. And diversification, if I go back to my college days and learning about diversification, because I was in college right around when asset allocation became a thing in the investment world, is the old adage was if you had, it was ancient China and they had many merchants that were trying to bring their goods downriver, and there was 10 merchants, they would split the goods between 10 different boats. So no one boat was carrying all of one merchant's items, so that if one crashed or they lost the cargo, not only, everybody would take a small loss as opposed to somebody taking a large loss. And that was the idea behind diversification. But asset allocation is just a little bit different, and it's important to understand it came about. There were some studies and research being done in the mid to late 80s, and it was really codified by this guy Roger Gibson in 1989. Wrote a book with the amazing title of Asset Allocation. And he was a professor. He's managed his money now. He's going to be close to retirement. But yeah, he did a lot of research, and he found that diversification alone was kind of useless. And when he did what's called back testing, so he can't go forward, he's looking at historical things and testing different theories based on historical returns, it was less about the actual performance of the individual investment. So if you look at investment categories such as large companies, small companies, international bonds, domestic, government bonds, things of that nature, when you create a portfolio of those, the underlying asset inside of each category is less important than the percentage you have in each category, and maintaining those percentages. What do I mean by that? Is when we do an asset allocation for a client, when I present it to a client, I don't see it this way, but I present it this way, is we present it as a pie chart. Is, let's say it's 50-50 stocks and bonds, and let's say 25% is in large U.S. companies and 25% is small, and the bonds are just mixed up and things like that, is we've got a bunch of different pieces to that pie. And what I want to make sure of is that I maintain the percentage between the pieces. So if one investment versus the other does very well, so one category, large companies, small companies, whatever it is, advances beyond the others, its piece of the pie is actually going to increase. But there'll be another piece of the pie where their performance relative to the other categories isn't doing as well, and their piece of the pie will decrease. And what Gibson proved was the best thing to do is to do what we all know we're supposed to do. Is I ask people, what's the first rule of investing? And they go, the first rule of investing, I go, buy, and they go, low, sell high. I'm like, exactly. And that's exactly what asset allocation does, is on a category basis. It says if one category is done very well, we want to sell a little bit of that category. We want to buy the one that's not doing as well. And why is this so groundbreaking? Is it breaks the emotional attachment we have with the investing process. Because if I talk to people that own individual stocks and they track individual stocks, boy, they fall in love with a stock, whether it's XYZ Corp, NVIDIA, IBM, whatever it is. And they get very attached to the stock, especially if it's going up. If it's going up, they want more. If it's going down, they might want less. They don't like the things that go down. Oh, this lost me money last year, we should sell it. Because we're very emotionally involved. When we look at it under asset allocation and we look at it as a whole, we're much less apt to become emotionally involved with the individual investments. And what that allows us to do is to sell things when they're doing well and taking those profits, and then taking those profits and investing them into other categories that are doing poorly at that time. Now, if you have Fidelity managing your money, they do this. If you have Fisher, they do this. We do it, obviously, for our clients. I've believed in it. Is on the cutting edge of asset allocation when I got out of college. Is, read the first edition of Roger Gibson's book. I want to say it's on the 7th or 8th edition at this point. Read the first edition of his book in the early 90s and really adopted it then. Or you may be doing it yourself. The real trick is understanding how to build the portfolio, what percentages should you have really in each category, and then what's kind of your trigger to adjust that allocation. What we call is reallocate or rebalance the allocation to bring those large pie pieces smaller and to make the small pie pieces larger is probably the hardest thing to do. And a lot of people struggle with it. You may want to get professional help with that. Is some of the robo investments out there just do it automatically. I know a lot of 401ks, that have asset allocation built in will just automatically do it on the quarter, which may or may not be a bad thing. But what if the market takes a big move one way or the other in between? It's something you have to remember to do, or have your advisor remember to do if you have an advisor. It might be an area where this is not a complex situation, but it might be something where you want to look at having some professional help. If you have questions about that, you can jump down into the notes on this video and reach out. We can maybe help you out and kind of point you in the right direction and get you the help you need. With that, stay safe out there.
Thank you for listening to our podcast. Remember, the views expressed are not necessarily those of Successful Money Strategies. All content is for educational purposes only and should not be construed as an endorsement of any third party or their views, or as a solicitation or offer to sell securities or provide investment, tax, legal, or consulting services. We believe the information presented to be reliable, but it is not guaranteed for accuracy or completeness. Investing involves risk, including the potential loss of principal. Hypothetical returns do not reflect actual trading and may not be indicative of the performance of any specific investment. Always consult with a qualified financial advisor before making any investment decisions. Past performance is not a guarantee of future results. Additional information, including management fees and expenses, is provided on our Form ADV Part 2, available upon request, or at the SEC's Investment Advisor Public Disclosure website, https://advisorinfo.sec.gov.